Thus far, we have focused on reorganizations designed to either acquire other companies or to restructure or otherwise revise an existing corporation. We now turn to divisions, or if you will, divisive reorgs, which are intended to somehow divide existing corporations, hence the term divisions. This term needs a bit more explanation. The code does not use the term divisive reorganization. It refers to these types of transactions as divisions. The term divisive reorganization is sometimes used in practice, but the term division is often used as well. Note that both terms are used in this course. When done so, assume that what is meant is a division, in other words, a transaction that qualifies under Section 355, or so much of 356 as qualifies because of Section 355. The general notion of a division is that shareholders who previously owned interests in one corporation will now own interests in two or more corporations. Now, divisions do not cover the situation where one corporation redeems part or all of one or more shareholders' interests in exchange for non-stock assets of the corporation, as illustrated in the diagram on the slide here. Divisions contemplate that corporate assets remain in corporate solution. But if a corporation does redeem one or more shareholders in exchange for the operating assets of a trade or business of the corporation, then this redemption may qualify as a partial liquidation, giving sale or exchange treatment, taxable sale or exchange treatment, due to Section 302(b)(4, thereby avoiding dividend treatment. But it is not enough for the shareholder or shareholders of one corporation to own stock in two corporations after the transaction in order to qualify under Section 355. Divisions contemplate the distribution of corporations, each of which has an active trade or business. The theory here is that you should be able to divide trades or businesses as long as they remain in corporate solution. One scenario not contemplated by the divisive reorganization provisions is the distribution of stock in a corporation which does not actively conduct a trade or business. Consider the scenario in the diagram in front of you. X has a subsidiary S1 which does conduct a business, but it also has a subsidiary S2 which only has cash and marketable securities. If X distributes S2, that would not be a division under 355 because S2 does not have an active trade or business. The concern here is that the distribution of stock would be a disguised dividend or redemption. This concern of a disguised dividend or redemption permeates the divisive reorganization provisions. It is this concern that creates the need for an active trade or business in existence for some minimum period of time. The division provisions, Section 355, apply whether the corporation has a spin-off, a split-off, or a split-up, examples of which follow. First, a spin-off, as illustrated, an example of which is illustrated in the diagram in front of you. X has two subs, S1 and S2, each of which have an active trade or business. In this possibility, X simply distributes the stock of S2. And so the transaction has the essence of a distribution. It looks like a distribution. Now, it will not be treated as a distribution if all of the requirements of 355 are met. It'll be treated as a division. But again, it has the appearance of a distribution. An example of a split off is illustrated in this diagram. Again, X has the two subs S1 and S2, each of which have an active trade or business. In this case, one of the shareholders, B, transfers down X stock in exchange for S2 stock. So that would be an example, again, just an example of a split-off. What distinguishes a split-off is that it has the appearance of a redemption. Again, not that it would be treated as redemption. If the qualifications are met under 355, it would be treated as a 355 division, but it has the appearance of a redemption. Finally, we have the possibility of a split up. Again, an example of which is illustrated on the slide in front of you. Same initial capital structure, A and B own X, X owns S1 and S2, each of which have an active trade or business. In this case, X liquidates, and in liquidation, it distributes S1 and S2 to A and B. Now, in this example, they are split evenly. The stock of each company is split evenly between the two shareholders. It could just as easily be S1 goes to A and S2 goes to B, but that, whatever. I mean, it's just an example. What distinguishes this type of transaction, a split up, is that, again, it looks like a liquidation. Now, I would again note that these are just examples of each of these types of divisive reorganizations. Also note that the terms spin-off, split off, and split up are not terms from the code, but they are terms widely used in practice. Notice that in each instance I indicate the transaction takes the form or looks like some other transaction, but in each case I indicated the transactions are not in fact treated as this other type of transaction, because again, if they qualify as divisions under Section 355, they would be tax-free. What are some of the reasons for divisive reorganization? Well, for example, you may want to give an important employee an interest in that part of the business that he or she is most directly involved in. And so maybe that corporation, that subsidiary that the employee has the greatest involvement in would be spun off such that that employee could get an interest in that corporation and not the more general combined corporation. A second reason is to separate risky businesses from more stable businesses. For example, Altria spinning off Kraft in order to separate the stable business, Kraft, from the risky business, the tobacco arm of Altria. A third reason, prepare for a financing where only part of the corporation is marketable for this purpose. And so there may be one sub that is in a particularly hot area at the time. You would spin that sub off or split it off, and then you would go through an IPO for that particular corporation. A fourth reason, antitrust reasons. You may be required to separate businesses for antitrust purposes. A fifth possibility, to separate feuding shareholders. Now we'll come back to the concept of feuding shareholders. Note that it must be to benefit the corporation, not the shareholders, although they certainly can have a double purpose. Also note that you have to heed the lessons of a landmark case in this area, Gregory versus Helvering. Gregory versus Helvering was a 1935 Supreme Court case. This case typically stands for the basic proposition that it is not enough to comply with the letter of the law. You must also conform to the spirit of the law. This basic proposition applies in the tax law in general, but it is particularly important in the context of divisive reorganizations. This case involved a divisive reorganization, and the principle remains an important one in divisive reorgs. One should be aware that if you have a transaction that complies with the letter of the division provisions, but not the spirit, then the transaction is in trouble. The transaction will not qualify under Section 355. The basic statutory pattern of divisions is found in Sections 355 and 368A1D. I guess the first point in regard to the statutory pattern for divisive reorganizations is that, depending on the circumstances, you may not need a transaction actually defined as a reorganization. While Section 354 requires a transaction defined as a reorganization, Section 355 does not. But there are circumstances that do require a transaction defined as a reorganization, more particularly a de-reorganization under 368A1D. It depends on the corporate structure before the transaction, and we will come back and look at that. Section 355A1A provides that no gain or loss shall be recognized by shareholders who receive distributions of stock or securities with respect to their stock, or by security holders who exchange securities for stock or securities if certain requirements are met. Note that stockholders may, but need not, exchange their stock in the distributing corporation. It is enough for the corporation to simply distribute its subsidiaries' stock. In other words, a spin-off can qualify. The requirements, all of which must be satisfied under Section 355, are as follows. Number one, the stock being distributed must be stock in a subsidiary which the distributing corporation controls immediately before the distribution. Number two, the parent corporation must, at a minimum, distribute stock representing control of the subsidiary. Now, here, control is as defined in Section 368C, which we considered earlier in the course. Also note, if the parent distributes less than 100% of the stock or securities owned, then the parent must establish that the retention of any stock or securities did not have tax avoidance as a principal purpose. Number three, the transaction as a whole must not be principally used as a device for the distribution of E&P, and we will consider this device clause. Number four, the transaction must involve a division of at least two trades or businesses, and these trades or businesses must be considered active trades or businesses. I refer you to Section 355A1C. And number five, the parent must not distribute boot. Boot for this purpose includes all those things that we considered boot for other reorganizations, things like cash, other property, excess principal amounts of securities, amounts received for accrued interest, non-qualified preferred stock, etc. But it also includes corporations acquired in taxable transactions within the last 5 years, as well as stock acquired in taxable transactions within the last 5 years. So all of those are considered boot under 355. If boot is distributed, then technically Section 355 does not apply. If Section 355 would have applied but for the distribution of boot, then Section 356 will apply. And so again, 356 handles those situations where it would be a 355 transaction but for the receipt of boot. Now, if an exchange of stock or securities is involved, in other words, in a split off or split up, and boot is received, then Section 356A1 will require the recognition of gain, but limit it to the amount of boot received. So it would be the lesser of the realized gain or the amount of boot received. Section 356A2 will treat the gain as a dividend to the extent of ratable accumulated earnings and profits if the receipt of boot has the effect of a dividend. Same rules as we saw for other reorganizations. On the other hand, if an exchange of stock or securities does not take place, in other words, there's just a distribution, and that distribution includes boot, then Section 356B applies. Section 356B treats this distribution of boot as a distribution to which Section 301 applies. And so the distribution of boot is automatically treated as a distribution. You don't face any of the 356A2 limitations we looked at earlier in the course. You should also note Section 355C, which clarifies that distributions or redemptions of boot can cause taxation to the distributing corporation if the boot is appreciated. The final basic provision is Section 368A1D. Again, note that Section 355 can apply even if you don't have a reorganization described in Section 368. But you may need a de-reorganization in order to first get into a condition for a Section 355 transaction. Consider the diagram presented in the slide. A and B own X. X owns a subsidiary S1, which has one active trader business, and X directly owns a second business. Can X redeem B without tax to B? In other words, can X redeem B in exchange for business number 2 and come under 355? Well, here X cannot directly distribute business 2 to B in exchange for B's stock because business 2 is not in corporate solution. The direct exchange of business 2 might be a redemption under section 302B4, but B would be required to recognize gain or loss. And so the question becomes, well, how can X get around this problem? What can X do to circumvent this problem? This diagram illustrates what X can do. Notice that it starts off at the same corporate structure as before. A and B own X. X owns S1 the sub, which has business 1. X also directly has business 2. And so what X could do is drop down business 2 to NewCo in exchange for NewCo stock, all the NewCo stock. X can then distribute the NewCo stock. In this case, the illustration shows that X is distributing the NewCo stock equally to A and B. X could also distribute the NewCo stock to B in redemption of B's X stock, which would be a split off. That would also work. Either way, though, the point is that this would now satisfy the requirements of 355, at least on the face of it. What are the requirements under 368A1D? Well, the requirements are as follows. 1, a transfer by a corporation of all or part of its assets to another corporation. In the diagram in the prior slide, X transfers part of its assets, business 2, to NewCo. Second requirement, immediately after the transfer, either the transferor corporation and or its shareholders control the transferee corporation. Shareholders include those shareholders taken out by the transaction. Here, the transferee corporation is NewCo. X or its shareholders A and B control NewCo immediately after the transfer. And so that requirement is satisfied. Number 3, stock or securities of the transferee corporation must be distributed in a section 354, 355, or 356 transaction. Here, the stock distributed falls within section 355. And so the drop-down accomplishes what it set out to do. Section 355 now applies because business 2 is distributed in corporate solution.